My question for you here today, with this rare earths news out of China, I mean, if it looks like a nationalization and it feels like a nationalization, is it a nationalization? Hello and welcome to the Northern Miner Podcast. My name is Adrian Pocobelli, exercising a free press. Welcome back to the show. Here is the article. China tightens management of rare earths with new regulation. Bloomberg News via mining.com. And maybe in China it doesn't make a difference. I mean, maybe as a communist country, there's an underlying assumption that it is already all nationalized. But let's take a quick look at what it says here. China tightened the management of its rare earths industry with the approval of the first comprehensive regulation governing the mining, metal smelting, and circulation of the mineral. Rare earths belong to the country, and no organization or individual are allowed to claim them, the State Council said in a statement on its website. The state will take charge of protective mining of the resource, it said. The new rules take effect on October 1st. It continues, government agencies will have control over the total amount of rare earth mining and smelting and will establish a product traceability system, it added. So they're going to start tracking them as well. The regulation also stated penalties for illegal activities involving the mineral's output. So maybe this is just semantics. Red meat headline, China nationalizes rare earths, but it sure feels like it over here. The country accounts for about 70% of the world's production of rare earths. It has been consolidating its mining assets and established China Rare Earth Group in 2021 through the merger of several key producers. But if we actually drill down on this, I mean, what is it saying? I'm going to repeat the line here. Rare earths belong to the country, and no organization or individual are allowed to claim them. The State Council said in a statement on its website, the state will take charge of protective mining of the resource, it said. The new rules take place on October 1st. What it sounds like to me is this is a precautionary move by China in the event of geopolitical volatility, which kind of makes sense. I mean, what would you do if you own 70% of the rare earth supply chain? And I think it depends on the rare earth. I think in some cases it's actually higher. Again, there's about, 17 rare earths here, and some are harder to get than others. In some cases, I'm sure China just owns the entire thing. Look at synthetic graphite, which is not a rare earth, but case in point, where they own something like 99%. Last we heard from our graphite experts. So this also falls on the heels of a very interesting in-depth report from Reuters on Europe's attempt to, quote, regain rare earth glory. And here is the headline: in race to regain rare earth glory, Europe falls short on mineral goals. This is by Eric Onstad at Reuters. And I just want to highlight a couple of areas here. This is halfway down the article. Under a new EU law entered into force in May, the bloc has set ambitious 2030 targets for domestic production of critical minerals required for its green transition. 10% of annual needs mined, 25% recycled, and 40% processed domestically by the end of the decade. Another highlight, EU demand is forecast to soar six-fold in the decade to 2030 and seven-fold by 2050. The EU will struggle, however, to meet most of the goals in rare earths, according to production forecasts gathered by Reuters and interviews with over a dozen industry executives, consultants, EU-funded officials, industry groups, and investors. Now, just for context, this came out on June 27th, and the article of China's announcement came out June 29th. 2 days later, also interesting timing, after this big report came out. As this Reuters article says on Europe's shortfall on rare earths, it says here China accounts for 98% of EU rare earth permanent magnet imports. EU Commission spokesperson Johanna Bernzel said they could not confirm the Reuters finding, but said the bloc would do its best to promote projects that help meet the goals in the CRMA, which is the Critical Raw Material Act. Quote, projects in Europe will benefit from a streamlined permitting process, as well as coordinated support for accessing de-risking financing tools and matchmaking with downstream users, end quote. And finally, we have a quote here from Ryan Castillo at consultancy Adamus Intelligence, which specializes in critical minerals. Quote, "The window between now and 2030 is going to close very quickly in the context of how long it takes to get some of these projects and processing facilities off the ground." Again, where we see in a very stark, clear way the geopolitical nature of natural resources. Continuing on, interesting developments also where we're seeing geopolitics and natural resources collide. A headline out of the Financial Times: Philippines courts investors for China-free nickel supply chain. Manila pitches itself as alternative for Western countries seeking to diversify sources of EV battery material. So we're seeing Philippines make the play as a nickel producer. If you look at the chart here, they are still far, far behind Indonesia. So just a couple of things I wanted to highlight in the article. So first we have a quote from Serafino S. Rodolfo, Undersecretary of the Department of Trade and Industry, who told the Financial Times, quote, "There is room now for the Philippines to be a significant player for batteries," end quote. And the article continues, "The Philippines' nickel output is just a fraction of top player Indonesia, where government officials say 90% of the industry is controlled by Chinese companies," something we've discussed many times here. And we have another quote from the Philippines Undersecretary of the Department of Trade and Industry, Seferino Rodolfo, who said, quote, "It's a race between China and the U.S., end quote. He said, noting that Philippines had, quote, "a really strong argument to go for a non-Chinese investor so that we can be the supplier of non-Indonesian, non-Chinese nickel," end quote. The Philippines' push also comes as it seeks to build closer ties with the U.S. and its allies amid escalating tensions with Beijing in the South China Sea. Last week, Chinese Coast Guard vessels rammed and boxed in Philippine military resupply boats, an incident that left one Philippine soldier severely injured. So final part on this, but no deal is on the table for now due to U.S. reluctance to sign an agreement in the middle of an election year, officials in Manila said. The Philippines is also aiming to produce greener nickel with the help of investors by using renewable energy to power smelters, Rodolfo said, distinguishing it from Indonesia, which relies on coal-fired power plants extensively, earning it a reputation as a producer of dirty nickel. So this is also a very interesting point. The Secretary General of OPEC actually made this point in a post on critical minerals, a realistic assessment. Javier Blas, the columnist at Bloomberg, tweeted that out. Very interesting. Critical minerals, a realistic assessment. And in it, H.E. Hytham Al-Ghais, OPEC Secretary General, makes the case that this whole idea that you're going to get critical minerals without using oil, coal, and gas is a little unrealistic. As it says here, critical minerals mining is also an extremely energy-intensive activity, and one that today runs on hydrocarbons. It could not function otherwise. The use of coal and gas is vital in refining the minerals through various thermal and chemical processes. For instance, blending to aid the removal of other metals and in heating to high temperatures to produce more pure forms. Petroleum-based products are also used for excavators, bulldozers, dump trucks on site, as well as various forms of transportation to move minerals from supply to demand centers. So, how the metal is going to be made and processed, the energy that is used for that really does, like we've seen movements in the US where it's almost like constituencies who are traditionally not super favorable towards mining, where the way out of that box, you might say, is saying, hey, if we can make a green mine, and we've seen in Nevada, there was government funding really to help you greenify your mine, that all of a sudden, if the energy you're using to extract resources, if that is green, then all of a sudden you're kind of back in the good books. And that seems to be what the Philippines Undersecretary of the Department of Trade and Industry is saying here. We need not coal-fired, but some sort of green energy to really make this nickel green here in the Philippines. So very interesting article there. Now we have another headline here. This is out of the Financial Times. U.S. sought Congo mines deal for Swiss trader Mercuria. Plan includes relaxing sanctions on Israeli billionaire to counter Chinese control of critical minerals. It's a similar tale. This is the Financial Times. Scrolling halfway down the article, the unusual U.S. initiative to relax sanctions on Dan Gertler, Israeli billionaire, has been spearheaded by President Joe Biden's senior energy advisor, Adam Hochstein, and reflects the increasingly fierce competition between the U.S. and China for access to the minerals needed for clean energy infrastructure. Notice the word access. This is, I think, part of the reason we're in the bind that we're in, which is back to this idea that we're mentioning with these Sprott physical commodity funds 2 weeks ago. The uranium fund, for example, which lit a fire under the uranium price, as we even heard from analysts over here, the argument is being made that these Sprott physical commodity funds are all in the name of price discovery. But I think the underlying assumption is this is all predicated on unlimited amounts of material, and that simply if the price goes up, then we create more, right? And then the price comes down. That's not really what I'm seeing, though, when I see the U.S. lifting sanctions on people because they want, as far as the Financial Times is saying, access to the minerals needed for clean energy infrastructure. We look at the headlines from Angola last week. The U.S. is not saying we want to process the copper that comes out of the copper belt in the U.S. They're saying, no problem, Angola, you can process it, at least from what we read there. And what that tells me is this isn't about necessarily getting it at the best price. This is simply securing access. And when you're simply trying to secure access, that tells me that if the metal runs out, the metal runs out. There is not an infinite supply of natural resources here. As anybody who's been listening to the copper narrative in the last 5 years knows, Mark Bristow has pounded the table, so to speak, repeatedly, that the big copper deposits, the low-hanging fruit is gone. So just one more paragraph in this article. A couple of paragraphs down, the U.S. government has rarely intervened in international mining projects so directly, but Biden's administration has made access to critical metals a foreign policy priority. Again, they use the word access. And just one more line here, a couple of paragraphs down, improved U.S. access to copper and cobalt is deemed so important that the Biden administration is proposing to lift its restrictions against Gertler in order to facilitate a sale. And so you can read all the details on the FT, but pretty interesting development there. It just goes to show how important resources are becoming in this discussion. And if you think that's just common sense, you haven't been here then in the last decade when policymakers didn't care at all. It wasn't on the radar. And people in the industry were saying, we're going to have a problem here. And that warning was not heeded. And here we are. Now, the highest office in the land, it is a major priority, according to the FT. Now, continuing on, we have a conflict on the east side of the DRC with the M23 rebels. They seem to be gaining momentum. M23 seizes town in East DR Congo as rebels gaining ground. This is voanews.com, and they have an AFP article here. In Kanya-Bayonga, Democratic Republic of Congo, the M23 militia group has seized another town in the war-torn east of the DRC as the rebels gain more ground, sources told AFP Sunday. Kinshasa accuses Rwanda of backing the Tutsi-led M23 rebel group, which has seized swaths of eastern DRC in an ongoing offensive launched in 2021, something Kigali denies. On Sunday, the M23, which stands for March 23rd Movement, moved in the town of Kirumba in North Kivu province, which has been rocked by violence since 2021, when the group resumed its armed campaign in the region. Kirumba is the biggest town in the south of the Lubero territory, where the group has been advancing, and a big commercial center with over 120,000 residents. And we have a quote from a local official who did not wish to be named, who told AFP on Sunday, quote, "We regret that the town has since yesterday evening been in the hands of the M23, end quote. He said the group was now heading north from the town. Quote, "They are numerous, some arrived on foot and other vehicles," end quote, a civil society leader who asked to remain unnamed told AFP. During a meeting with residents Sunday, the M23 said, quote, "They are going to Butembo and Beni, then to Kinshasa," end quote, which is the DRC's capital. All to say it's getting pretty intense over in the DRC. One more headline here. This is news24.com, As DRC turns 64, M23 rebels, and Rwanda has President Felix Tshisekedi talking about war. So we've been following this for a while, and it doesn't seem to be going away, does it? One more headline out of Africa, the Zimbabwean. Of course, Zimbabwe is to the southeast of Zambia. And Zambia and the Democratic Republic of Congo, of course, host the Copper Belt. Now, apparently they used to be pretty good allies, Zimbabwe and Zambia, sharing a rapport in their anti-colonial drives in the past. Now, the U.S. has been forced to deny Zimbabwe's claims that it's militarizing Zambia. And this is the Zimbabwean. The head of U.S. Africa Command denied Thursday claims by the Zimbabwean government officials that Washington is setting up a military base in neighboring Zambia and want to move AFRICOM operations there from Germany. I would actually think it's more because they're getting kicked out of Niger that they would need somewhere else. But, U.S. Africa Command is denying it. So just an interesting development there. Again, geopolitics all over the place. A couple of more stories here. We had what seemed like a coup attempt in Bolivia, which seemed to end before it really began. Just looking at some video here of police running away from the massive crowds in Bolivia. Guess they're not putting up with a coup over there. So pretty interesting. Another headline, Brazil's mining industry pushing hard to prevent new tax. This is BN Americas. And so they're trying to fight off higher taxes as the Brazilian Congress debates regulations to tax reform approved last year. I think they want to put a 1% tax on natural resource extractors, and they want to do it at the very end. With whatever you're making, they just want 1%, and the companies are not liking that at all. Also, Mediterranean Shipping Company, also known as MSC, major shipping company, has suspended their main operations in the Red Sea after fresh attack. And also, I was noticing on what is going on in shipping, very interesting YouTube channel. Apparently, you're seeing a huge amount of cars being exported by ship right now, and it kind of looks like this is part of China and BYD just exporting their cars all over the world here. So coming up, we have a couple of great guests on the show. We have Kari Granger, CEO of TGN Consulting, with all of the talk of M&A, merger and acquisitions in the mining sector right now. I thought it would be great to bring on Kari Granger to discuss the complexities of actually doing an M&A. How hard is it to do this? What are the kinds of challenges you're going to face from a company perspective in doing an M&A? Culture, how does management tend to deal with M&A? How does labor tend to deal with M&A? And also how AI is impacting the workforce. So very interesting guests as our feature interview. Also coming up, we have New Pacific Metals President and CEO Andrew Williams for this week's CEO Spotlight, who talks about the company's two very promising projects in Bolivia, a silver-focused company. Super interesting interview. With that, if you want to find us online, you can find us at northernminer.com. You can find us on Twitter at northernminer, and on Instagram at The Northern Miner, and on Facebook, LinkedIn, and YouTube, where we also host these podcasts, and wherever podcasts are available, including Spotify, SoundCloud, and Apple Podcasts. And with that, let's turn to Andrew Williams, President and CEO of New Pacific Metals, for this week's CEO Spotlight. Joining us today, I'm very pleased to welcome to this week's CEO Spotlight, Andrew Williams, President and CEO of New Pacific Metals. Andrew, welcome to the show.
Good to be here, Adrian.
It's great to have you, Andrew. So tell us, for those that don't know about New Pacific Metals, could you introduce the company and tell us a little bit of what you're up to?
Sure. Thanks, Adrian. So we are a precious metals development company advancing two major silver discoveries that we've made in Bolivia over the past several years. Our most advanced project, Silver Sand, a couple days ago, we published our pre-feasibility study on the project, highlighting a $740 million net present value, 37% IRR project, sub 2-year payback, over 2-to-1 NPV to CapEx ratio. I mean, just a phenomenal project that, as we've gone from PEA to PFS, the quality of that discovery has really withstood the rigors that the engineers have thrown at it over the last little while. And so we're continuing to advance that project forward. We also have our second project, Carangas, another major discovery that we made 2021 that in September of last year, we published our inaugural resource estimate. And then we've been working since then on our preliminary economic assessment on that project that's due out in September of this year.
So you have two projects going on in Bolivia. And of course, we just had that coup over there. How are you feeling about everything going on there? I guess stability is a good thing.
Yes, yeah, for sure. And obviously, yeah, Bolivia was in the headlines a couple days ago, not for the reasons that you typically want to see, but most importantly, when the event happened, our priority, of course, was the safety of our people, which we were able to achieve successfully. And by the time we were finished even digesting what was going on, and then the coup just ended. So it seems to have come and gone without a lot of fanfare. Our operations were unaffected and we continue on business as usual. And I think if you step back, the country politically is coming into an election in the fall of next year. So we still got some time to go, but nonetheless, things are heating up. As some of you may be aware, Bolivia has been run over the last nearly 20 years by a government with a more socialist bent. But unfortunately, the country finds itself in a situation where they really are in need of dollars and investment and economic growth. And that's why it's our belief that with our two projects, Silver Sand and Carangas, we're very well positioned here in a government that's increasingly opening itself up towards foreign investment.
So tell us then about Silver Sand. I assume this is the flagship then, and what exactly do you think is there?
We made the discovery several years ago, outlined a 200 million ounce resource, pure silver. That's one of the attributes that makes Silver Sand unique is most of the world's silver is produced as byproducts of base metals. So to have a pure silver deposit of the kind of scale that Silver Sand is, 200 million ounces, high grade or diluted head grade in the PFS studies, it's 105 grams per ton. And that's probably 40 to 50% higher grade than the average open pit precious metals mine coming online today. And so it makes good intuitive sense why, again, through the PEA and into the PFS, the economics are still very, very strong. And Silver Sand screens today as one of the best, if not the best, undeveloped precious metals deposits anywhere in the world. So we're going to continue to advance the project forward. And hopefully in the not too distant future, it'll become one of the next great mines anywhere in the world.
And you just released a pre-feasibility study. So what does that mean then for investors? Do you also have all the permitting together? Like, how do you see things with the project in that regard?
Yeah, so I think technically every time we throw it through a gauntlet with engineers and accountants and whoever else, metallurgists that are involved in it, the project still comes through unscathed. So we're very comfortable with the robustness of the deposit and the engineering around it. I think for us, really, the next big trick card is to make meaningful progress towards our environmental permits, as you said, and that's an exercise that we've been continually engaged with over the last while, right from the local communities that we're involved with up to the highest levels of government. And so we're continuing to methodically work through that process. It takes time. It's built on relationships and building trust one by one. And that's what we're engaged with in a very disciplined way as a company, and we'll continue to do so. And hopefully in the not too distant future, we'll have a breakthrough. But you're absolutely right. That is really the next major milestone for us as a company, is to make meaningful progress towards our environmental permit at Silver Sand.
Okay, excellent. And Carangas, is that also then primarily a silver project or 100% silver? Tell us a little bit about Carangas.
That's a great question, and it's one that is not all that straightforward. I think the great thing about Carangas is that it's a polymetallic discovery. We've got at the depths of the deposit over 1 million ounces of gold that recovers very nicely, and then a transitional lead and zinc zone, and then a top layer at the Carangas project that's closest to surface that hosts silver, lead, and zinc. So as we're working from our resource estimate, which was published last September, towards our preliminary economic assessment study that's due in and around September of this year, we're focusing on, or really asking the question, how do we best put forward a development scenario that gives us the best shot at becoming a mine one day? And we started looking initially at a big pit that would take the silver zone, the lead and zinc zone, and the gold zone at depth. But what we found is that we can really put together a more financeable, buildable project if we just focus on that upper zone, and in particular, a higher grade lens that's richer in silver with a nice zinc and lead byproduct credit. So that's what we're going to do as part of our PEA study, is to just focus on that silver zone with the lead and zinc byproduct credit as our main scenario. And then we'll show an alternative case where we can mine the entire thing and demonstrate the optionality at our Corangus project, depending on who the buyer or the developer is. If you want to develop a smaller scale project that's easily financeable, or the big bang maximum NPV project with the big super pit. But for the PEA study, we're really going to focus in on that upper silver zone and demonstrate a financeable and buildable project at Corangus.
Okay, interesting. And so are these two projects then, are they fairly close together, or are they in separate parts of the country?
They are in different departments. They're like provinces or states, as we're familiar with them in Canada and the US. The Silver Sand project is located in Potosi, which is the more mining-centric province of Bolivia. And our Corangus project is in neighboring Oruro. You can get from one project to the next in about 10 hours, bombing down a really nice 2-lane paved national highway at about 140 kilometers an hour, depending on your driver. So they are within driving distance, but it's not like they're close enough where we'd be able to share common infrastructure. And the really nice thing as well about having them in the two different areas is that they're different governments, and they know that only one project can be built at a time. And so it gives us a nice, healthy competitive tension between the two departments as we progress both projects along the permitting journey.
Okay, excellent. And just finally on the area, are there companies nearby here, or are you guys kind of on your own?
So within Potosi, we've got 3 major mining operations. As our neighbors is probably too colloquial a term, just given that, again, we're all multi-hour drives away from each other. It's not like, say, the Carlin Trend in Nevada, where your neighbors, you can just lift your head up and see them down the road. But we've got within Potosi, the San Cristobal operations, a 50,000 ton a day open pit silver zinc mine that was run by Sumitomo for many, many years. It's now run by a private company. We've got San Vicente, which is run by Pan American Silver. They've been in the country for over 20 years. They're actually our second largest shareholder. That mine continues to run today. And then run by Andean Precious Metals today. It was formerly a mine that was built and run for many years by silver mining giant Coeur d'Alene. That one's actually reasonably close to our silver sand deposit. So those 3 operations continue to run today, and they've been very successful operations over the last 15 to 20 years. But again, mines don't last forever, hence the importance of bringing online new projects like our Silver Sand and Corangus projects in the hopefully not too distant future here to reinvigorate the mining industry in Bolivia that's got a long and rich history.
Indeed, it sounds very promising. And so putting this all together then, what is your roadmap? How do you see the next, couple of years rolling out for the company?
Project advancement is really the name of the game for us. So both our technical studies, which we've just put this pre-feasibility study out, we're a couple months away from publishing our preliminary economic assessment at Corangus, at which point we'll have to make a decision on how we advance the engineering and technical work at both projects from there. But I think more importantly is our ongoing work towards our environmental permits at both projects, both Silver Sand and Corangus. We've got active efforts in country advancing the permits at both Silver Sand and Corangus. And really that's how we're driving value for our shareholders. When you look at the mining industry, what typically attracts the lion's share of attention amongst investors and analysts are exploration plays putting up splashy drill results. But quietly in the background, I've noticed this. I was in the investment industry for a while before joining New Pacific Metals, is that these developers, right, they're the ones that quietly work in the background, grinding out the hard yards, doing the engineering work, the permitting, the financing, that really have demonstrated a good business model towards creating sustainable value. And that's what we're going to continue along with our 2 great projects, is to advance them along the development curve over the next while here before ultimately making our decision about what's the best way to finance and develop these mines? Do we want to tender them to the highest bidder? Do we want to try and go about it ourselves? I think that's the beauty of having two great projects and making good progress on them, is that it puts us in a very strong position to control our destiny down the road.
As we wrap up then, what is your message for investors? What do you want them to know about New Pacific Metals?
I think just reiterating what I said previously, the fact that we've got these two incredible projects, right? Silver Sand is one of the best, if not the best, undeveloped precious metals deposit anywhere in the world. Karangas is also looking very, very interesting, and we're excited to release that PEA study and daylight value for a project that we feel like isn't getting any recognition from investors. If you look at the current silver price environment, $30 silver roughly, our Silver Sand net present value, and the PFS is over $1 billion. And then you throw in whatever number we're going to come out with Karangas. There's a huge amount of embedded value in our company, and it's up to us to, in a disciplined way, advance these projects forward to unlock that value. And again, in a way that's really tried and tested in our mining industry, with these successful project developers creating quite significant value for their shareholders. That's the roadmap that we're committed to, is to continue to advance our projects and drive that value into our share price and really close that gap between our underlying net asset value and our market cap today.
Andrew Williams, President and CEO of New Pacific Metals, thank you for joining us and sharing your insights on this week's CEO Spotlight.
Thanks for having me, Adrian.
And thank you to New Pacific Metals for sponsoring this week's episode of the Northern Miner Podcast. Turning to the website, Miner M&A Spotlight may shift to tech and Freeport. This is Reuters via mining.com. Mining bankers are all dressed up with nowhere to go now that BHP's attempt to take over the non-South African parts of rival Anglo American has hit the skids. The question is where the M&A spotlight is next going to fall in a sector newly buzzing with intrigue. The smart money right now seems to be on something involving Canada's $25 billion tech resources or $72 billion New York-listed Freeport-McMoRan. BHP's Anglo interest, which petered out on May 29th, has focused everyone's minds on copper. Demand for the red metal is robust given its key role in the energy transition and an artificial intelligence-related data center boom. But supplies are constrained. BHP's boss Mike Henry's 3 rebuffed takeover proposals for Anglo, the last of which valued the target at $47 billion, suggest big miners reckon it's cheaper to buy new supplies than invest in new ones. That said, it's not immediately obvious who's next on the block. Henry could wait the mandatory 6 months and have another pop at Anglo, but he'd still have to work out how to separate the UK-listed miner's juicy copper mines from the other bits he doesn't want. Anglo boss Duncan Wanblad, meanwhile, is unlikely to be an M&A aggressor. His successful defense against BHP requires him to spend the next year or so hiving off problem areas like diamonds. Rio Tinto, the other big global mining beast, was assumed to be waiting to pounce on other targets while BHP was distracted swallowing Anglo, which it now isn't. The picture doesn't get necessarily any clearer in the next echelon down. Major copper-focused players, including $26 billion Antofagasta, whose shares have doubled in the last 2 years, and $85 billion Southern Copper. These boast annual production of over 600,000 tons and 900,000 tons, respectively. But Antofagasta is 65% owned by Chile's Luxic family, which isn't showing signs of selling, and Southern Copper is 90% held by Grupo Mexico, led by Mexican tycoon Germán Larrea Mota Velasco. Canada's $11 billion First Quantum Minerals held over 700,000 tons of annual copper output last year, but its Cobre Panama mine in the Central American state has been embroiled in a spat with the domestic government. And so here are the two candidates that this article is focusing on. Freeport, which is in contrast largely held by institutional investors, looks a more promising M&A candidate. CEO Kathleen Quirk, who took the reins this month, needs to find ways to make her equity story more exciting. Analysts expect Freeport's copper production to barely increase in the next 5 years at 1.3 million tons annually, according to estimates polled by Visible Alpha. She also recently conceded in a Financial Times interview that acquisition, while not her priority, was an effective way to boost copper output. And here is their other focus. Tech is alluring for a starker reason. Boss Jonathan Price's copper production could roughly double to nearly 600,000 tons by 2028, according to analyst estimates using Visible Alpha data, and Teck's 60% copper EBITDA margin forecast for 2025 exceeds Freeport's 45%. While the Keevil family exerts an Antofagasta-style grip on the shareholder register, its special voting shares will flip to common stock in 5 years. After he completes the sale of Teck's steelmaking coal business to Swiss rival Glencore, Price's group will become a hugely attractive target. So more talk of M&A in the mining sector. Continuing on, metal firms confused by ESG regulations but hope for future price premium. A theme we've been discussing here for quite a while now. This idea of the green metal. I think we have to call it here halfway through the year, one of the big themes of the year. This is Reuters via mining.com. Executives of metals and mining firms said this week they are confused by the many different standards on environmental, social, and governance, also known as ESG, and hope there will be price premium for their products if they meet those standards in the future. Quote, "There is no unified ESG standard for us to follow," end quote, said Bryce Lee, a director at Zhejiang Huayu Cobalt Company. Lee continues, quote, "Generally, we know the direction, but when it comes to the daily implementation of the detailed standards, procedures, and assurance processes, we are facing a lot of requests. This really confuses us. But not only us. Some of the downstream customers are also confused," end quote, Lee told a seminar hosted by the London Metal Exchange in Hong Kong on Thursday. Meeting ESG standards is increasingly important for companies because of growing pressure from their customers, governments, and consumers to reduce harmful behavior. But those standards are set by a number of different organizations globally. Lee said it is a challenge for companies in the middle of the supply chain to request their suppliers, the miners, to comply with ESG requirements from their clients, such as car makers, because the rules are not always mandatory at the miner's location. And here's another quote from Bryce Lee at this LME conference in Hong Kong. Quote, "I don't see any pricing credit for people who have done it or who have the commitment to do it," referring to a premium for lower carbon EV battery materials. So we're back to the energy issue. Is it clean energy or quote unquote dirty energy that is producing your metal? Very interesting. Continuing on, London Metal Exchange mulls adding warehouse in Hong Kong. Bloomberg News. The LME is exploring whether to license a warehouse in Hong Kong as it seeks to strengthen services to clients in China, the world's biggest metals market. A third-party study on the feasibility of a Hong Kong warehouse has been commissioned. Bonnie Chan, Chief Executive Officer of Hong Kong Exchanges and Clearing, which owns the LME, said at the Metal Exchange's annual Asia seminar in the city on Thursday. You know, it seems to me, and this is just pure speculation on my part, but it seems to me that earlier we were seeing they want to get pricing out of China. Now the LME is going to open a warehouse in China. At what point are they just going to change the name from the London Metal Exchange to maybe the Hong Kong Metal Exchange? Just a speculative question here. And here's a quote from LME Chief Executive Officer Matthew Chamberlain, who said in a Bloomberg TV interview, quote, "Our mission is to get as close to the mainland as possible. Hong Kong is absolutely at the center of our plans for that bridge," end quote. A little further down, we have another quote from Matthew Chamberlain, CEO of LME. Quote, "The ability to deliver into Hong Kong, to truck or to rail metal down here on the fantastic transport network is something we are really excited about," end quote. And just a few headlines here. Copper supply gets a boost as Chile shows signs of recovery. So it seems every few weeks we get a story on how Chile copper production is faltering, then it's recovering, and we have another one here that says it is recovering. It's Bloomberg News via mining.com. Copper production in Chile, the world's biggest supplier of the wiring metal, is showing signs of recovering from 20-year lows. Output in May was the highest this year, rising more than 8% compared with both April and the year earlier, according to data released Friday by the country's Bureau of Statistics. While top producer Codelco has indicated its output won't begin to show year-on-year increases until the second half, other suppliers are picking up the slack after grappling with lower ore quality and operational setbacks. Authorities are looking for a 5% increase in countrywide copper output this year due to an expansion at the Quebrada Blanca mine and improvements at BHP's Escondida, so Teck Resources to the rescue in Chile, interestingly. Another headline, Southern Copper to restart development of Peru mine on Monday. This is Reuters via mining.com. The Tia Maria mine in the Islay province of Peru's Arequipa region has been on hold for years amid community opposition over fears of the mine's environmental impact. Protests against the mine left 6 people dead between 2011 and 2015. An internal memorandum issued by Grupo Mexico and Southern Copper on Friday and reviewed by Reuters notified employees about the start of work on Monday. A source with knowledge of the plans told Reuters that the document was authentic. Another headline, Argentina is about to unleash a wave of lithium in a global glut. 4 new projects will finally begin to churn out lithium in the weeks and months ahead, according to a yet-to-be-released federal government timeline seen by Bloomberg News. That will almost double production capacity in Argentina, whose growth potential has long lured the attention of battery makers around the world. And a couple of paragraphs down, yet for global lithium markets, the extra production comes at a time when buyers are already well supplied, with inventories piling up amid the gloomy outlook for electric vehicle demand. Spot prices of lithium carbonate in China have slid to the lowest since August 2021. And there was a story from Electric that I never got to, but it was very interesting. And what it showed was, let me just bring it up here, that BYD sales of electric vehicles were up 18% from the first half of 2023. So comparing year on year, the first half, where plug-in hybrids were up 58% year on year. So kind of interesting within this lithium glut discussion, hybrids are up 58%. Kind of interesting. Another headline, lithium price surge unlikely to return. According to Fitch, this is Henry Lazenby at the Northern Miner, the lithium market has entered a new normal period of stability with sustained price surges a thing of the past, analysts at Fitch Solutions said in a webcast Thursday. Falling lithium prices in the past year means prices are expected to remain downcast for the next decade, Sabrine Chowdhury, head of BMI Commodities Analysis, said from Singapore. This outlook is reshaping the industry landscape, presenting opportunities and challenges for major producers and junior developers. And here's a quote from Chowdhury, who said, quote, "This stabilization is primarily due to a rapidly expanding global supply, which has already pushed the market into surplus. We expect no return to previous highs for lithium. Prices will remain below the peaks of 2022 and 2023 for at least 5 to 10 years. Continuing on, Botswana GDP shrinks most since 2020 as diamond output plunges. So Botswana really suffering. This is Bloomberg News via mining.com. Botswana's economy contracted by the most since the peak of the pandemic in early 2020 after diamond production plunged. GDP shrank an annual 5.3% in the first quarter, compared with growth of 1.9% in the prior 3 months. The downturn was primarily influenced by a decrease in real value added of the diamond traders and mining and quarrying industries. Botswana is the world's largest producer of rough diamonds by value, with the revenues making up the bulk of the southern African country's budget receipts. The decline is likely to make meeting its fiscal targets for this year difficult. The central bank already warned last week that the government would probably miss its economic growth forecast of 4.2% because of weaker mining output. Those are your news stories. Now, let's take a look at metal prices. And turning to metal prices, let's take a quick look at the bond market for context. The U.S. 10-year bond is yielding 4.45%. That is up 0.2% from last week. I wonder if it's the debate. Seems like a sizable move. The UK 10-year gilt is at 4.26%. That is up 0.19%, so almost 0.2%. And the Italy 10-year bond is at 4.12%. Also up 0.19% from last week. So 10-year bond yields moving higher. Turning to precious metals, gold is trading at $2,340 even. That is $3 higher than last week. Silver is trading at $29.69 per ounce. That is 47 cents higher than last week. Platinum is trading at $977 even. That is down $23 from last week. And palladium is trading at $964 even. That is down $6 from last week. Turning to industrial metals, copper is trading at $4.41 per pound, edging down 2 cents from last week. Iron ore is trading at $106.51 per metric ton. That is even from last week. And aluminum is trading at $1.14 per pound. That is unchanged from last week. Lead is trading at $1.01 per pound. That is 3 cents higher than last week. And nickel is also trading higher at $7.91 per pound. That is 9 cents higher than last week. Tin is also higher at $14.85 per pound. That is 3 cents higher than last week. Cobalt is unchanged at $12.32 per pound. And lithium continues to drop at $12.59 per kilogram. That is 29 cents lower than last week. So lithium falling through the floor here at $12.59 per kilogram. Uranium is trading at $85.75 per pound. That is $1.25 higher than last week. And zinc is also higher at $1.33 per pound. That is 4 cents higher than last week. So zooming out, generally edging just slightly higher in most metals, with the exception of platinum and palladium, as well as copper, which have edged just ever so slightly lower, and those are your metal prices. Coming up, I'm very pleased to welcome to the Northern Miner Podcast for the very first time, Kari Granger, CEO of TGN Consulting. Rarely do we talk about the business of management, where arguably a lot of the battle of this industry is won and lost. So here, with all the M&A discussion in the air, I've brought on Kari Granger to discuss the dynamics of what happens when a company does M&A, and also to discuss how AI is impacting the workforce. I hope you enjoy it, and I will see you on the other side. Joining us today, I'm very pleased to welcome to the Northern Miner Podcast for the very first time, Kari Granger, CEO of TGN Consulting. Kari, welcome to the show.
Thank you so much, Adrian. I'm so happy to be here.
It's great to have you here at such an interesting time in the natural resource industry. Of course, there was a massive bid just the other week on BHP for Anglo American. So we're starting to hear sounds of M&A, merger and acquisition. And I thought you'd be an interesting person to bring on as you help organizations, you mobilize executive agendas. So just to start out, could you tell us a little bit about what you do at TGN Consulting?
Yeah, sure. Thanks. So we are a leadership consultancy that specializes in a successful mobilization of your agenda. So what does that mean? Usually it comes across as big change, complex change. M&A falls right into that. Organizational restructure can fall into that. Turnarounds can fall into that. Strategic pivots can fall into that. Or, gosh, we need to do something. We think it has to do with strategy or culture, or maybe it's structure. Maybe it's our leaders. We're not quite sure. It's complex. How do I mobilize around this thing I need to do? And so sometimes you have clarity around that. Sometimes you don't. But our work is to really support you in getting the workforce, getting your executive teams mobilized to achieve the thing you know you need to do, but aren't quite sure how to get the humans going in the right direction.
Yeah, I imagine it can be quite a complex situation. I mean, all of these things from a distance seem quite simple, and then you start getting into, these specific situations, and they get quite complex. So generally speaking, I mean, I'm sure you have different challenges that you are brought in to address, but what are some of the biggest challenges you face when you're dealing with a 21st century company? Are there any kind of commonalities you find within organizational structures that you kind of see over and over again?
Yeah. So you asked about structure. And oftentimes when we're making a big change, what we often see is either you'll shift strategy, but you won't necessarily shift the structure to align with that strategy. right? Or you might be focused on a cultural aspect, like, for example, oh, we want more cross-functional collaboration, but your structures are set up for siloed information. So oftentimes we see that there's an outdated structure for the new shift, right? And so depending on what are your change initiatives, in the US, we have the Grand Canyon, and these are like huge canyon walls, and the water can only go in one direction. And if you compare that to like a marsh, near an ocean where the water just goes everywhere. Structure is a lot like that. And so, what are those Grand Canyon walls that you want to set up to ensure the water is flowing in the right direction? That's the same thing with the human engagement and the workforce mobilization is oftentimes we see a structure set up for the old, and you're trying very hard to get people to row in a different direction, but they just can't. We also see, that structurally, culturally, the same thing. You can say, oh, we're going to create a more collaborative or innovative or empowered, structure. But culturally, we have a very hierarchical one, right? So one time we were brought into a group with the US military Pentagon, and they were really looking at, well, how do we shift our orientation around a new war concept? And they thought, well, we have all these old guard resistors. No, you didn't have old guard resistors. You thought it was a person problem, an employee problem, a leadership problem. You didn't have resistors. You had a structure that was very hierarchical and required that one person from one department go all the way up and around to talk to the next. And so culturally, structurally, it was very traditional. And yet the objectives required a cross-functional collaboration to be able to actually invent and move into a new concept.
Very interesting. So I guess there are different ways of managing a company. So boiling it down to a certain degree here for our, say mining executives that might be listening to the program,
Yeah.
With all we just said in mind here, what can managers then do better in order to run their companies better? Like, is there a little checklist? Because in a sense, what's interesting, and I don't know what you think about this, but a lot of managers don't actually go to management school.
Right.
Like they don't get trained, they get promoted and all of a sudden, okay, I'm a manager.
I think there's a couple of places to ground yourself, right? So one is leadership, culture, strategy, and structure go together. So oftentimes when we come in, and unfortunately we'll come in at the back end of something when things go wrong. I love it when we're brought in at the beginning to help architects, but we see that you'll have your strategy consultant, you'll have your culture consultant, you'll have your leadership person, and maybe your org design. And they're actually working at cross purposes because different people hold those initiatives. So one of the things you can do is to be looking at, okay, where we say we're going. If you don't have strategy, it's unfocused, right? So here's where we're going. And then you're looking at your leadership team to say where we're going now in this time, in this era. Do we have the right leadership capabilities? Because there are foundational capabilities, but for example, some places need a consistency. You win by consistency. Other places need kind of a bull in a china shop to really shake things up, right? So do you have the right kind of leadership capacities for your strategy today, right? And strategies, some can shift over time. So are those two things lined up rather than having like, oh, leadership programs are happening over here in HR and strategy is happening over here with the CFO or with the strategy officer, or with the executive team? You got to have those lined up. And then culturally, of course, we want people feeling good, but culturally, if you don't have leadership, it's unmanageable. If you don't have strategy, it's unfocused. If you don't have culture, it's unsustainable, right? So culturally, we're doing a big change right now with a Fortune 500 company and a pretty big turnaround. And they say, well, we want to really develop the leaders. And I said, well, that's really great. Let's develop the leaders. But culturally, they are extremely, I call it job collapse, but the 4 layers up, they'll go down and manage what's happening at the store. Right. And so they don't have the cultural patience, nor do they have the cultural setup to really equip and empower those leaders. So how do you strategically, culturally, leadership come together? And then the structure really reifies things. So what we were saying before. So as an executive, ensuring that your initiatives, you're looking across those 4 domains, that there's coherency, right? You're not going in one direction with the other. So that's one. Another one is There's a really big difference between change management and workforce mobilization. So change management, you're looking at your planning, you look at an M&A and there's so many work streams that, kind of have to come together, and those are very valid. Most of us do have some training in change management. Here's the plan. Let's take the action. Let's organize and let's move out. But what people don't know about or don't see is the thing that undermines change. It's the thing that has 83% of mergers not boosting shareholder returns, or 80% of acquisitions fail to meet their projections, is because you don't know how to mobilize that workforce. That's usually the case. Mobilizing workforce is psychological. How do you take your workforce and allow them to align their identity, align what the future holds for them, align their relationships with the shift? It's psychological. So the workforce mobilization often gets relegated to, a couple town halls, or, let's bring in the culture consultants or something like that. But it actually deserves its own work stream. And there is a real expertise and a method for workforce mobilization. So whenever you're doing big change management, have your workforce mobilization work stream go hand in hand. And sometimes we'll come alongside of like a KPMG or a Ascension or something like that, just to help with that side.
Okay, excellent. So we're starting to see mergers and acquisitions, say in mining, for example. And of course, you work across many domains, including the military, as you mentioned. What are the main frictions? It sounded like you were saying that M&A is oftentimes not really that successful. Like, can you just speak about M&A and maybe, I guess, some of the frictions and how to do M&A properly, if there is a way?
Yeah, I'll speak on the side that we see often. I mean, there's so much expertise out there on how to bring different work streams together. And there's a lot of technical side of that. And so I'm not going to completely speak on that side. What I will say is one of the big failure areas is, for example, taking for granted the work that's needed to shift your key critical employees, right? There's some key talent you do not want to miss. You don't want to lose that key talent. There's ways of working that you need people to work differently now. So, if you're just doing a bolt-on and people can kind of operate on their own in the same way, it's not as critical. But if you're really trying to integrate, right, you're trying to integrate, people are different than technology. If I've learned how to be successful in my area and I know how to use my system, or we know how to do our procedures, or we know how to use this technology, and all of a sudden you want me to use a different one, for executives, we've been around the block a lot. It's not that big of a deal. We might get a little annoyed. Oh, now, like for me, I love Zoom and you're going to make me use Teams. Okay, fine. I'll get around Teams. Not a big deal. In healthcare, we see EMR systems. It's a huge deal for people. Top leaders, we've been around. The people who are trying to be successful in their one job and you change the game on them, it's a big deal, right? I know how to be successful. I'm now afraid I'm not going to be successful. I know my relationships here. I know my boss. I know my peers. I know the people I work with. You now want me to work with different people. Well, that's a big deal for me, right? What are my future prospects? I thought I was next in line for this promotion. I've been working at it. And all of a sudden I got a bunch of, peer competitors. And so there's a lot of things that is mostly these human side of where do I belong? Who do I get to be? My identity? How do I be successful here? Sometimes there's geographical changes where I called my home. These things, you can address them proactively. And if you just account for it, if you just allow that to be part of the conversation, I had a organization that they just changed emails one day and you don't think that's a big deal, but actually an email's kind of my identity a little bit. And so there's just a little bit more care for how do you actually take care of people's psychological transition. And what that ends up doing is retaining a lot more people, and so especially your critical, key talent. So some of the downsides is you can't get people operating as well or in the new systems as quickly as you'd like to, or you lose key talent, or you've got some resistance, or you've got some internal conflict, or people are slower in the uptake, and you're just like, why, why is this happening? Well, you didn't take care of the psychological aspects that matter to those people. And it doesn't take much, Adrian.
It's simply, recognizing the fact that some of these issues are going to come up. It's almost to a certain degree managing expectations, it sounds like, is half the battle. Okay, so very interesting. So as we're wrapping up here, then talk to me about labor. As you mentioned earlier, the mining industry, we've had a narrative for years now that it's getting harder and harder to find people. Not as many young people are taking geology as they did 20, 30 years ago. We're going to have a whole bunch of retirements coming in the next few years. Can you speak about that? This idea of labor, maybe AI and finding that labor?
Yeah, so there's a couple interesting things coming together in your question there. Just as a side note, when I look at some of the exponential technologies, which is something that we support, kind of that psychological transition, even with executive teams. Some people are afraid of these exponential technologies, or they think linearly. So they think, well, yeah, it'll come around when it comes around. But is it critical for executives today to be thinking exponentially, not just linearly? And why do I bring that up? Because, materials is huge right now in your field. And so, there may be new interest in the younger generations if you can make some of those connections. But besides that, here's the thing and why it's so important to retain your talent, not just bring in talent, but retain the talent you have. If you look at the projections around global workforce, there's a real difference between desk-bound workers and deskless workers. And I think in mining in particular, you've got to really pay attention to both. And if you look at the numbers today, for every deskless worker, that's like a laborer, someone who does not work at their desk. They're out in the field. They're in the mines. They're in trucks. They're not behind a desk. They're not looking at their computer. So deskless workers. For every deskless worker globally, there's 2 jobs. So already we have about half the labor force we need. And I mean across the board, from construction to even, ambulance drivers, to airport baggage handlers, to baristas. If you go through your day, you'll see how many deskless workers there are. Currently, there are 2 jobs for every deskless worker. By 2030, it's projected that there will be globally 8 jobs for every deskless worker. It just has to do with demographics and who's the aging population, how many people are aging out of work right now and how many people are coming into work. So like in the United States, by next year, 25% of the workers will be over 55. In 2018, the number of people on the planet over 65 surpassed the number of children under 5. So just globally, there's a changing demographic. Okay, so if you take that and you say, all right, well, if desk-bound workers represent 20% of the global workforce and deskless workers is 80%, well, we have a pretty big shortfall, right? And so then you look, okay, in the United States, it's like 1 in 6 by 2030. You say, oh, wow, okay, well, I better keep my workers. But there's AI. Is an AI going to automate and, solve our problems here? Maybe if we get a lot better at it. Right now, for most automated jobs, actually increases the labor need. Right, which is really kind of counterintuitive. And, I saw this in a retail store where they had self-checkout. And actually, for every self-checkout, they needed like 1.5 workers to ensure that it's going well, that it's working. Okay, so then you say, well, AI is trying to automate, but all of the funding, like the VC funding into AI automation, is going to desk-bound workers, not deskless workers. So the thing here is really begin to invest in 2 things. 1, your talent, keeping them. And number 2, augmentation. So if you can augment a worker and they can be 3 times as effective, augmentation turns out to be where you want to start to look. And it also increases safety, shows that laborers are a lot happier with augmentation. So I would point executives in that direction.
Kari Granger, CEO of TGN Consulting, thank you for joining us and sharing your insights on the Northern Miner podcast.
Awesome. Thank you so much for having me, Adrian.
Thank you once again to New Pacific Metals for sponsoring this week's episode of the Northern Miner podcast. Thank you once again to Kari Granger for for giving insights on the organizational side of company structures and what happens in M&A and AI. And thank you, dear listener, for joining us once again. If you enjoyed the show, please leave us a review in the Apple Podcast directory, share it with your friends, and until next week, take care.